Hi everyone, today we have an amazing institutional investor with us. She has more than 15 years of institutional investing experience in private markets globally, having invested across private equity sub-asset classes and worked in New York, London, and Hong Kong. Most recently, she was a managing director at GCM Grosvenor based in New York. She was formerly a partner in the customized fund investment group of Credit Suisse Group AG. She led the establishment of CFIG's Hong Kong office and is a founding member of its London office. Currently, she serves on the executive committee of Private Equity Women Investor Network, or as we call it, PEWIN. Founded in 2008, PEWIN is the preeminent organization for senior female investment professionals in private equity. This organization currently has over 700 members globally, spanning across the US in 6 regions: Europe, Asia, Middle East, and Africa. So super excited to welcome her today. Welcome to SheVC. I'm your founder and host, Gayatri Sarkar. So today is that special day. Today we have Iris, Zhao, Fiorello with us. Super excited to welcome you here. Iris.
It's a pleasure to be here, Gayatri. Thank you for inviting me.
Thank you, Iris. I am super excited to see the amazing work that you have done, especially across the different work offices, whether it's London, whether it's Hong Kong. So I would love to know your take, especially your experience as an investor in the private equity market, how it has shaped you as an investor, and would love to know a little bit about your journey.
Well, I've had the good fortune of having lived and worked in the US, Europe, and Asia in the last 15 years. And I've witnessed the global private equity industry really evolve during this time. Gosh, there's so much to cover here, but just, starting on the size of the market, it really has expanded notably. Take fund size, for example. Middle market buyout funds used to be under 500 million in size and maybe up to $1 billion on the upper end 15 or 20 years ago. Today, a $3 to $7 billion fund is considered middle market. And that's really because the large end of the market has gone up to 15 to 20 billion in size. We've also seen a great comeback in the venture industry due to the rise of internet, mobile age, and social media. And investors who've experienced the dot-com era in the late 90s and early 2000s will know that venture was really out of favor in the institutional world for a long period of time after the bubble burst as a result of the losses suffered. For larger investors, the smaller size of the venture funds also made it quite challenging to deploy because it's difficult for the smaller funds to really move the needle in their portfolios. So, but the ecosystem, has really matured and developed over the years. If you look at SaaS, for example, it's one of the most common investment themes employed by growth funds and a number of buyout funds today. The concept has really been around for a long time before Salesforce and others came along, but you needed to have the right market demand. You needed to have the right infrastructure, both on the provider and the client side, to deliver and receive the technology seamlessly at an affordable price. And so for all those reasons, we've seen a lot of growth in venture deployment and investing in the last 5-7 years or so. Similarly, on the consumer side, you now have a generation of people who were born and raised in the internet era. And so it's really part of their daily routine and entrenched in every aspect of their lives. Interestingly, in emerging economies, emerging markets, where traditional infrastructure such as the banking system and real estate are less developed, the adaptation of internet and mobile technology is even faster and stronger. So China's private equity market, was barely in existence 20 years ago when I first started. Today is one of the 2 leading venture ecosystems globally, rivaling the US. and each, with opportunities and dynamics that are really unique to its own. So it's not a giant, single market anymore. It's actually quite different with local dynamics and opportunities. And the growth in venture has also been driven by the demand for more effective drugs, more affordable treatments. COVID obviously, reminded us of how urgent and important this is. But we as consumers also want more customized treatments on an Uber model, right? So,
Yeah.
so digital healthcare, as a result, emerged as a growing theme out of these market developments in the last 5 to 10 years. And beyond buyout and venture, we've seen the private equity asset class itself really broaden in the last couple of decades. Infrastructure is an example, which has been around. Infrastructure itself has been around for a long, long time, particularly for in the public sector. But it really took off as an attractive private market asset class in the last 15 years or so. The strong demand in secondary and co-investments that we've seen, across institutional investors' portfolio, that's fueled the growth for both fundraising and capital deployment in these areas as well.
That's great. I love what you touched about, especially on US and Asia's dual ecosystem and how the digital healthcare has started and how China has fueled into private equity growth market. I would love to know what your experience in these different markets taught you, and also how do you think the institutional LPs' appetite evolved over time?
Yes, it's interesting to witness the evolution on the institutional LP side, because I think everything at the end of the day between what is happening in the market, a lot of that is driven by institutional investors' demand. And I talked about co-investments and secondary briefly just now, but that's been one of the major themes that I've seen developing significantly, in the last 15 years. When I was out in Asia back in 2009 or so, the Asian institutional investors was still, largely developing. There are a number of very large institutions today. At the time, were just starting to invest in private equity. You'll remember there was also a time of global financial crisis, and so there was a lot of fear, a lot of headline concerns, people reading newspapers about, economy crashing and the system failing. So there's a lot of fear and lack of understanding of what was happening in the private equity portfolio. And much of those investments were concentrated in particular segments in the market. And so over time, we've seen these large institutions really grow and become quite sophisticated with large internal resources and developing their in-house expertise and needing to really, because of the large amount of capital that they have, to find more effective ways and efficient ways to deploy capital and generate the returns. And so co-investment has been a real area of interest for not only large LPs, but really LPs across the board, because you're able to gain more of that direct exposure to the companies, which allows you to control your portfolio construction just a little bit more relative to investing in funds. Sometimes these deals are done at a more cost-efficient basis, depending on your relationship with the fund. And for all those reasons, there is the potential to enhance returns. And so, that is a major theme that I've seen, that I've observed in Asia, but globally as well. Of course, it requires a lot of expertise to execute on these deals. Particularly if you're investing in sectors like in healthcare or certain sectors in technology. And so you really do need to develop that in-house resource and know-how in order to deploy your capital and invest in attractive companies. And of course, as these portfolios, as institutional LPs portfolios have grown over the years, some of them have gotten tremendous in size with, more than 100 or maybe even 200 managers in the portfolio. Well, how do you effectively manage this portfolio and maintain the quality and be able to generate interesting returns and beat your internal benchmark, particularly when you only have a smaller team, as many of these institutions do, and the amount of time you have to spend on each fund, relative to the size of the team, sometimes that ratio just doesn't work. And so then how do you effectively streamline that portfolio and manage the portfolio that allows you to gain some liquidity and perhaps redeploy that capital into more interesting areas or areas that align better with your investment objectives. And so, of course, the secondary market took off. As a result, we've seen the significant fundraising and capital deployed by a number of secondary funds. And so these are some of the major trends that was able to observe and kind of be a part of as I worked with institutional investors and was investing myself.
I love that take. And since we are talking about institutional LPs' appetite and their portfolio benchmarks, I would love to know, coming back to the present time, especially during COVID-19, how the investors' investment appetite and risk profile changed, especially more recently during COVID-19. And would love to know, how important do you feel the time diversification aspect? But we'll come to that a little later. But I would like to know the appetite and the risk profile first, especially with this current time, because what we're seeing with COVID-19, initially there was definitely a constraint at the economic side, but right now there's enough money in the private market, and there's a huge amount of money that has been pushed into the IPO market very lately. So I would love to know your take on that.
Yeah, this has certainly been a very strange year on many accounts. At first, there was just a lot of frenzy and question marks, right? Everyone was asking everyone else the same questions. What is happening? Certainly, on the health side, and it affects you personally, with your families and your own health, but also on the portfolios, what kind of impact it has on the portfolios. And a lot of that has kind of calmed down. The first, between March and May, there's a lot of digging, a lot of researching, a lot of wondering. And since then, people have relatively come to terms with a new reality. I never thought I would see people wear masks in the U.S. because in Asia it's such a, it's part of it's a common practice. But here, we're embracing mask wearing for our own health safety, which is very much needed. And so, people have come to terms with a new reality. But I think one of the main questions I have, and I think if I were a GP, would be very, very important is, should this environment prolong? Should we continue to see this, trend of working from home, no traveling, or if, COVID-19 passes and we somehow, we have a COVID-20 or another external kind of, factor that's interrupting this ability to work in the office and travel, what happens to commitments? There's been very, very few new commitments to new relationships that I've seen during the past 6 months or so. Investors, are investing. Investors are meeting managers, but most of the commitments have been on the re-upping side. And so, continue to back existing investors, which is important and makes sense. But for many of the small and emerging managers, if you're raising a first-time fund, or, you're trying to expand on your institutional LP investor base, this is a very challenging time. Ultimately, I think the experienced investors and especially the ones who've been through past cycles recognize the importance of maintaining that long-term perspective. And so while there may be some technical strategy, shifts or thinking about taking advantage of certain investment opportunities during this time, overall, my sense is that the experienced investors understand the importance of not timing the market and really maintaining that long-term perspective in their investment strategies. And some are even telling me, they said, I'm looking beyond COVID right now because it is what it is. Unfortunately, this is a time where we just have to take some unusual measures in doing diligence and evaluating opportunities. But I do hope that the hurdle can be crossed at some point where, because we do need to prepare for future disruptions, like a COVID. And so I do hope that over time, more institutional investors can cross the hurdle of, developing the internal resource and the capabilities to do due diligence, to meet with managers and to make commitments virtually. And GPs need to be well prepared on the other hand as well in terms of their fundraising process, the technology behind it, and the communication.
Yeah, totally agree. And I totally agree on the fact that you said timing the market is totally a fool's errand. And but investors have tried to do it time to time the market. So since we are talking about time, how important do you feel time diversification, especially the vintage year, is important when thinking about a PE portfolio?
Diversification, and I think in any portfolio, unless you have certain specific objectives, but generally speaking, it's important to have in a portfolio. For private equity portfolio, it certainly is important to diversify by vintage, keeping in mind what I said earlier about having that long-term perspective and consistently deploy across market cycles to generate the long-term return that you want to get from private equity. Part of, I think, the growth for secondary market is that it does help with vintage diversification, particularly for investors who are just coming into private equity. It's a good way to get into that diversified portfolio. And as investors are building their own portfolios, it's important to maintain that pace over the years to get a vintage diversification. I would say, in looking at some of the data, historically, vintages that came out of major down cycles have performed very well. And so that is something, to keep in mind is, again, it's one of the things that I keep in mind as I've looked at the markets globally or private equity landscape globally and across time is that, don't always let what is being printed in the headlines today can overworry you. There certainly is a lot to consider on a macro level. There's a lot of uncertainties going on. But over time, the experienced investors, will be able to find opportunities across cycles using that combination of keeping a long-term perspective and having some tactical plays at during various windows.
Yeah, totally agree with you that there's a lot of things going on, especially at the macro level. And since we are talking about the growth and the venture, would love to know your take, like a little bit about the new market opportunities for venture and growth, and how has the market changed in the last 5 years?
Yeah, as I mentioned before, venture was a bad word for a while among institutional investors. Just, I think the institutional memory from the .com era, was probably quite painful for a number of investors. However, I would say that the ecosystem has changed, and there are a number of developments, in this segment and in this strategy. As the industry and the market continues to evolve, Overall, I would say, across venture capital stages, the visibility has improved quite a bit. So, some years ago, when people think about, Series A investing or early stage investing, it was very obscure. It was very difficult, to really see what was going on. Well, today, that early stage, even down to the accelerator level, to seed and pre-seed, that level, we now can see institutionalized funds that are targeting those very early stages, very early stage companies. And so when you have more institutionalized funds across stages, it does improve the visibility into those markets. And allows investors to have options to invest really fully across the spectrum. Similarly, on the other hand, I never thought there would be $100 billion fund focused on venture, but there is now. And so both ends of the spectrum have expanded and have more players come in. And so therefore more capital to support across the investment stages. I would also say, the lines have blurred somewhat between venture and growth. That sometimes, it could be even challenging for some investors to say, well, do I bucket this in my growth portfolio or venture, or is this buyout? Because, when you have like a SaaS company that has recurring revenue, very stable, you can see kind of the path to profitability. And you can value it, using fundamental valuation and analysis tools. That is very different from a late stage, Series B round or Series G round with multiple billion of dollars in valuations. But both require, meaningful capital to be deployed. And so we've seen a number of growth funds, now really shifting to more what I would consider to be growth buyout, where they're taking control positions in these software companies, but they are high growth companies. You see, multiples of revenue expansion from organic inorganic growth during the whole time. And you're also seeing large buyout funds, and I see this in Asia. Buyout funds dipping into the venture realm, where they're coming into a later stage financing of a venture-backed company that started out with perhaps, backing from Sequoia and others, and are now taking a large stake in the later stage series of financing, where the company is now more mature and more established. And so the lines certainly have blurred. But I think overall, I'm optimistic that, the venture opportunity will stay for the long term because, as I said, the ecosystem has matured and developed. We now have multiple routes of exit. Even Salesforce of the world, who, once were smaller companies, are now ecosystems of their own. And so there are a number of companies who are being who are partnering or being acquired, who are working with Salesforce, and you have other Salesforces of the world in Asia. You have, Alibaba, Tencent, and Baidu's of the world. And so these industry leaders who have now grown into size will create and have created mini ecosystems of their own, thereby creating more exit opportunities for other venture-backed companies. And certainly the IPO market, if you look at what's happening now, really the tech side, the tech companies really, help maintain the buoyancy and the levels of where the indices are. And so I think overall, it's a bigger universe. There are more players. It's maturing. The talent pool is larger, and there are multiple avenues for exit. And do remember that the vast majority of venture-backed exits are not your unicorns or decacorns. They're below $1 billion, and that is perfectly fine. You can generate a great return high multiple, high IR return with a sub-billion-dollar exit, and majority of the exits in venture and growth are in that category.
Yeah, I totally agree with you, because that's what we see in the European market. And I mean, we generally invest in the Europe and the Israeli market. So we see the changes that are coming right now in the Europe and the Israeli market. Now, coming back to the venture funds and coming back to the PE funds. So how do you select your fund managers? I mean, how do you evaluate, especially the emerging fund managers? As you said, like now you never thought of having $100 billion venture fund in the market. Now we have, SoftBank. So what kind of track records do you think the institutional investors are looking for, especially not for the SoftBank kinds, but mostly for the very first time emerging fund managers in the growth and the diversity sector? Would love to know that.
I think by the nature that these are smaller managers and younger managers, institutional investors would want to have a higher return potential. You want a premium, right, for the risk that you're taking in backing these managers. It's one of the questions I frequently get asked, by emerging managers is, how do I present my track record? What is meaningful to you, and what do you want to see? At a high level, I would say every institution is different in their views of, what's an interesting emerging manager opportunity. Some of the family offices that I speak with, for example, or other institutions, are comfortable backing experienced professionals with no track record, but perhaps some demonstration of that you can execute on the strategy that you're able to, you can execute on the strategy that you're targeting for the fund. And then there are other institutions who are also investing in emerging managers, but they want to see a bit more of that demonstration, a track record. Perhaps they want to see at least a fund 1 or even a fund 2. Prior to considering in investing. And so I think it's the complexity of fundraising for emerging managers, but the more you can talk to LPs and understand specifically what each institution is looking for, in emerging manager. Do they invest in emerging managers? How do they define emerging managers? And what are the key criteria they look for? So for me, there's a big difference between a first-time fund and a first-time investor. And so what I look for is the team with experience investing in the strategy that they plan to execute on for the fund. And I look for some level of demonstration of success in this strategy. And so perhaps it's not a full institutional fund, perhaps it's a personal portfolio combined with some SPVs and co-invest that the manager is able to pull together prior to starting the fund 1. And perhaps there's a prior track record at a previous firm. And that's tricky, right? Because how do you verify the attribution of that track record? And perhaps sometimes the firms may or may not be comfortable giving the manager the attribution. And so we need to think through that. But ultimately, I want to see that the manager has the network, particularly if you're in venture, right? If you're in deal sourcing, but certainly across strategies, the network to source deals, the sense and the experience to identify and really assess the opportunity, and be able to execute and add value to the portfolio with some demonstration of success. The other point I would raise is I often get asked, well, the capital base that I've invested in my personal portfolio is so small. How do you demonstrate to institutional investors that you can do this at scale? And that's that is a great question, because the reality is, especially for many of the women managers, it's hard to pull together a meaningful pool of capital, to demonstrate a track record. So I would say, if you are doing friends and family, the managers are doing friends and family investments, or if there are some ways that you can demonstrate through a reference call with a portfolio company or with a company to say, you know what, I could have gotten 50 million allocation, but because my fund was small or because I didn't have a fund, this is how much I invested. But I have these 5 companies or 10 companies who would be willing to serve as my reference, and that had I had a fund at the time, I could have pulled together a much bigger allocation, or I also have brought in these co-investors. If you combine the capital, it will be be at a much larger scale than what I have invested personally or through my own platform. And so there's just various ways that you can think about to demonstrate your ability to invest and scale and invest well.
I love that. I love what you said about the track record and the attribution factor towards the track record. So how do you think the large LPs, especially the mega funds, public pensions, sovereign funds, and they can meaningfully invest in this emerging fund managers? Because most of these emerging fund managers have micro funds, which is currently becoming an asset class, and they have like $10, $50 million funds. But most of these large LPs, they write checks like for $50 million. Some of them write checks for $100 or $500 million. So when someone has that kind of capacity of writing those checks, how can they participate in the emerging fund managers round? Especially first time.
Yes, it's it's a challenge. I think many institutional investors who are writing the large checks, they certainly recognize the attractiveness of supporting and backing small and emerging managers, or even just smaller managers in general. But the fact of the matter is, especially if you're limited in your in-house resources, is underwriting a $5 million check probably takes the same amount of work as you underwrite a $200 million check.
Absolutely.
But it doesn't make sense. And so, but it doesn't mean, that they can't partake in this market. In fact, a number of the large public pensions and institutional investors are considered leaders in supporting small and emerging managers, and they've done a fantastic job. Some of them choose to work with a partner, either an asset manager or a fund of funds, and there are a number of fund of funds out there who are very skilled at doing this, and some who have been able to build up an in-house team at scale, and have the global reach and the resources to do so. They can do it in-house. And I know some of the investors in Asia, have offices all over the world, and they have very skilled and experienced teams throughout the offices to invest locally. And because, of the strong interest in co-investments, as I mentioned earlier, they are willing to invest in smaller funds to generate co-invest deal flow, as well as to grow with the managers over time. One of the great things about investing in smaller managers is that, if they become successful and as they continue to grow in size, it can eventually transition into a direct relationship, even if you're not invested directly with them earlier on. And so, these are some of the ways that I've seen institutional investors support small emerging managers.
Yeah, I totally agree. And I think institutional investors, especially who are writing the first check, they can get a lot of favorable terms with first-time fund managers. And I think that's very interesting. And we have seen that playing in the market. So coming back to your current position, you serve on the executive committee of Private Equity Women Investor Network, which is PEWIN. And it was founded in 2008. It's a preeminent organization for senior female investment professionals in private equity. I would love to know a little bit about the organization and how you're supporting all the women fund managers.
PEWIN, so Private Equity Women Investor Network, started 13 years ago in the US, and we're now a global organization. I helped start the Asia chapter about 5 or 6 years ago. We're active in Europe and Africa as well, in addition to the US. 700 members globally. The goal or the mission here is really to retain, to elevate, and to empower women. What's unique about this network is that we are dedicated to senior level women. So these are leaders at their respective organizations, many of whom are also founders of their own firms. Senior level women or largely investors. Vast majority of the members are investors, whether you're a senior level GP or LP. It's by invitation only. So members are sponsored by other members, and it's, potential members are candidates are vetted through a process. And so we spread and we grow our organization by word of mouth largely, but we're also able to maintain a high quality of the member base, which is fantastic because members really love, our members really love the events. I just did this survey of our members over the summer. I was really happy to hear the members really love the events and the opportunities to really connect with one another, because you're all senior level women, you're peers in the industry, and you can really have that level of conversation that is difficult to find elsewhere.
Yeah, totally agree with you. And I think PEWIN had done a lot when it comes to highlighting a lot of women CIOs who are working very closely with the women fund managers. I would love to come back to the roles of women, especially in the investment world, from the other side of the table, which is the LP side. So how do you think we can empower more women into the CIO roles, especially where they can create more diversity and woman-focused mandates, especially in their investments? Because there are not many women who are writing checks nowadays, and that is having a waterfall effect on women products and women investors, women founders. So would love to know your take on that.
Sure, and I should also address, I think the other part of your question is how does PEWIN support the small and emerging managers? But it's all part of the ecosystem here. Is we're trying to encourage more senior representation and retain more senior representation of women in private equity industry. But also, important part of that is helping women founders, right, who start and build their firms. And so to address kind of the, senior representation, how do you get more women to become CIOs? Well, I think by just looking at the member base of PEWIN, I think it seems like the industry has made some improvement, in the past decade or so. If I recall correctly, PEWIN started out as, I think, a group of maybe 12 or 15 women, and it's now grown to more than 700 and globally, which is fantastic. But it's not enough, right? I mean, women were clearly still the minority when it comes to being decision makers and holding decision-making level positions in the private equity industry. And I think there are a number of things that they really, needs to happen to have more representation at a senior level and more women in CIO roles. I think, how do you become a CIO, right? You need to stay in the industry long enough to build the experience that really prepare you to become a CIO, and there's a significant dropout rate, after the mid-level. And so, there's a clear need for firms to retain their senior level women, in order for them to have opportunity to become CIOs. There needs to be, the key stakeholders in the decision makers, the institutions, and the firms. There should be not only a commitment to gender diversity, but also execution on that commitment. We've seen California mandated, at least one woman per public company board. India, as an emerging market, is one of the few countries that have implemented this policy as well. And so in the private world, if there is a woman on the investment committee, she's usually the only one, and certainly, significantly outnumbered by men. And so, I think the stakeholders have a responsibility and accountability to make that the increase in the growth in senior women representation as well.
Yeah.
And at the end of the day, I think it's, we talk a lot about, actions and numbers. To me, having promoting diversity and really help drive diversity is less about filling quotas and numbers, but it's building a culture and really have that be part of your organization's DNA. And one of the ways you can achieve this is to help women start their own firms. I mean, what better way to drive diversity than by having more women own their own firms and be the decision makers of their, of their firms. I think it's also beyond helping the women start the firms, but also to help them scale their firms.
Yeah.
I mean, we've seen in the venture growth market, I see a large number of women who are starting their own venture firms, which is fantastic. They're all, very talented, seasoned, experienced. The vast majority of those firms are small. And so when you're faced with an environment like COVID, where we are today, fundraising is extremely challenging. And when vast majority of these firms are still young, and the track record is still young, you're yet to be able to demonstrate to your LPs on the long-term returns of, of your platform. Fundraising can be a huge challenge. And so, how do we help the women scale their platforms and their firms, in addition to helping them start their firms? I think it's equally important. And at PEWIN, one of the things that we do in playing a part in this area is we have a program called Pinklight, Project Pinklight. It started about 3 years ago now as an accelerator program. Is really designed to help women launch their own private equity firms.
Wow.
It's a smaller scale, but very deeply involved experience where we have a group of very successful and experienced GPs and LPs who are members of PEWIN. So, by definition, they're, clearly very senior in the industry, who are assigned to a prospective firm to provide advice and to provide counsel.
Wow.
Funds go through a presentation to this panel, and you have some very deep and kind of candid conversations about, your fund's positioning strategy, all the way to, how do you make the flow better on Zoom, right? Because all of these things matter.
Yes.
And the resources that are available, to these fund managers throughout network, that where we can be helpful in putting people in touch. And so we've counseled about 20 firms so far. They've raised more than $400 million.
Wow.
And and this is something that we are very proud of, and we hope that we'll continue to be able to do to help these firms really to start on the right foot in terms of building that communication and messaging and positioning with the institutional LP community.
Wow, I love that. And I think you touch base on so many points, which are so important. One is helping women not only starting their venture fund, but also PE firm, because there are not many women who are founders of PE funds. And also talking about having women on the public companies board, or having women on the investment committee, the executive committee. I think that is so important. And there are not many women who are on the public boards or who are on the investment committee boards of private equity funds or pension funds. So that's a very important take. And I love what PEWIN is doing. Now, I cannot believe I'm coming to the very last question, which is, how are you maintaining work-life balance? And I think, as I said, like during COVID-19, I thought, oh, we will have a lot of time since we have cut down those social experiences. But when it comes to venture capital, when it comes to investments, when it comes to private equity, this is not a job. It's almost a lifestyle. You cannot switch it off during the weekends. So I would love to know your take, like how are you preparing, during this pandemic, and what are the learning habits you have acquired? Because I'm still struggling with so many things, and I keep asking all my fellow investors, like how are they managing, whether it's the male investors or female investors?
Yes, it's hard enough as is, I think, being a woman, and I'm also a mother, to maintain that balance, during normal times. And so during COVID, my kids are doing a hybrid model where they're doing part of their schooling in school and part at home. And so juggling with all that. But I think, kind of bring it back to, at a high level, I love the private equity and venture industry because it forever kind of makes me a student, of there's always an industry or a new trend, particularly in venture. It kind of keeps me on my toes because it's always evolving and there's something new to learn as an investor. And so what it reminds you is, the importance of maintaining that curiosity and open mind. What seems odd or strange or unlikely today may be part of your daily life, 5 to 10 years from now. And so I think what's important to kind of think about that and keep that perspective as I, meet managers and learn about what they do. It's more about understanding and assessing whether they have the right experience and the right network to execute on their strategy successfully. And the other part of it is, because I'm juggling between work and family and many components of that, I find it helpful to compartmentalize and know how to work in segments and be able to transition quickly. And so because one thing, after this, I might have 20 minutes where I'm helping my kids with a particular project. And then after that, I have another call. And so how do you transition back and forth, between, 3 or 5 completely different things? That has been, a process of learning for me. And I think it's a skill that I'll continue to kind of work on. And the better I'm at it, the better I can balance myself. And lastly, really just enjoy the little things in life. Yoga has helped me quite a lot in taking the breather, even if it's like a 5-minute or a 10-minute quick session on the mat. I think that's I found that to be helpful personally. So all of these things, I suppose.
Yeah, I totally agree with you. I think yoga, meditation, and also the idea of switching on and off, I think that's a very important criteria and component in keeping the life balanced, especially when the work-life balance have become so grim, and it's almost like we are living in our workplace. So it's a very different world right now. So thanks a lot, Iris, for your time. I think we learned a lot about private equity and growth venture and how the world has changed. And also you brought a huge global perspective. So thanks a lot for your time.
Thank you, guys. I enjoyed it.
Thank you, Iris.